The US non-farm jobs surprised to the downside, coming in at 151,000 against a consensus of 180,000. As a knee-jerk reaction, the US dollar was aggressively offered across the board. After 2 weeks of intensive US dollar focus, the attention will finally shift to the Asia Pacific in the first week of September. The G20 meeting in Hangzhou, China, will of course be the main focus on September the 4th and 5th, where world leaders will once again discuss the state of the world's economy. On the menu, we have Brexit, the possibility of further fiscal and monetary easing from Japan, Germany's scepticism for more stimulus heading into the German elections, China's excess capacity, and more. However, the diversity of talking points suggests that any significant resolution or commitment out of this meeting may not be achieved. Now, let's move on to the major macro events to come. On Monday, Bank of Japan's Governor Kuroda will speak. Thanks to the broad-based US dollar rally, the yen could take a breather over the last week of August. The dollar-yen recorded a decent rally as dollar optimism temporarily pushed aside the mounting concerns about malfunctioning fiscal and monetary stimulus in Japan. However, if traders' attention turned back to Japan's domestic dynamics, we could expect a short-term bearish reversal in the dollar-yen. For the time being, the 102.4/102 zone shelters dip buyers, but below this level the sentiment could rapidly turn sour to bring the 100 level back on the radar. On Tuesday, the Reserve Bank of Australia will give its policy verdict. The RBA is expected to maintain the status quo and keep its cash rate unchanged at the historical low of 1.5%. There is little doubt that the RBA will keep its monetary stance soft enough to provide an appropriate playground for business expansion. However, with signs of stabilisation out of China, we could expect the RBA to retract towards a wait-and-see mode, especially now that the hawkish Fed is paving the way for a softer Aussie. On Wednesday, the UK's manufacturing and industrial production will be closely watched. Last week's strong PMI figures out of the UK boosted optimism in the pound market. We are coming to a point where we could consider that investors have mostly absorbed the Brexit shock and the knee-jerk negative readjustment has already taken place and been factored in. Unless new developments in negotiations with the EU take place, Brexit-related worries will gradually pave the way for a new era in the UK. This means new solutions, new business opportunities and new agreements. In this respect, better manufacturing and industrial data could further reinforce the sentiment in the UK and make investors smile. The upside attempts in cable suggest that there is potential for a further recovery in the pound. While the 1.30 zone has become a popular buy the dip over the past weeks, traders should be flexible trading the pound market, as many have kept their midterm target below the 1.3 level. Technically, the 1.3640 level, which is the major 38.2% retracement on the post-Brexit sell-off, is a reasonable midterm target on the upside. Below this level, the post-Brexit trend is still considered negative, in other words, is in line with the long-term bearish bias. For traders who are seeking to avoid the US dollar volatility and benefit from the strength of the pound, Euro sterling could be an interesting alternative. The EURGBP's post-Brexit rally is now subject to a correction, and given how hard the EURGBP rallied, there remains decent room for a downside correction. From a technical perspective, the strengthening negative momentum in EURGBP could bring the pair down to 0.8043, which is the major 38.2% retracement on the post-Brexit rally. Only below this level, we could consider the euro sterling in a fresh bearish trend. Wrapping up next week's agenda, the European Central Bank meet on Thursday. The central bank is expected to maintain its policy unchanged, and the market is not expecting any fireworks from September's meeting. Of course, the hawkish developments in the Fed camp are keeping some of the pressure off Mr. Draghi's shoulders. The Eurozone's macro picture is mainly unchanged, with moderate but stable credit growth, an inflation rate near zero despite all efforts, and slow growth. But there are positive developments from a market perspective. The Eurozone sovereign yields are no longer the main focus point of investors because Japan is taking care of the headlines, and the euro has stabilised at appropriate levels against the US dollar and is giving back its post-Brexit strength against the pound. From all perspectives, the ECB's policy is running smoothly at the moment, and that's all for the week ahead. Tune in next Friday, and goodbye for now.